Welcome, everyone, to this episode of Freedom Hub's Working Group. I'm your host, Jeff Cantor, along with my co-host, Charles Froman. We definitely want you to make sure we are sponsored by the Freedom Hub, which is absolutely the disruptor's intersection. And we're going to let you take a peek at where we're at as far as that goes. But we got a couple key things that we like to pay attention to. We are the site for health, wealth, and freedom. So really, you need your health, you need money, and then you obviously need the freedom. So that's why it circles around these three key issues. This is the tool we've got available that allows you to liberate yourself from the stranglehold of a conventional insurance process at patientempowerment.mpb.health. On the wealth side, we've got a special tab that you'll come to. And here, this is a perfect example. We had a client, they had 24, imagine that, but it was two people that married each other. So between the two of them, they had 24 debts, credit cards, student loans, the whole 9 yards. And it was going to take 20 years the way they were on track between the mortgage payment, which was kind of the longest debt load. They did it all in 8.5 years without changing one thing, no refinancing, no consolidating. They didn't make any more money. They didn't drop anything that they were doing, nothing. We just had them help them to figure out how to micromanage their money because they had all the power, like Dorothy and the Wizard of Oz. They had the money to escape. They just didn't know how to do it. Totally free report, all anonymous, no social securities, no anything. You'll check it out at the site, and it's really an amazing tool. And again, that allows you to get all these other things done because once you have money and health, now you can start helping participate in improving the world. And that's what we're really all about in the end. So when you get to the site, it's your-mp.com. You'll see there's a lot of good drop downs. Here's that wealth one I was referring to. But most importantly, under the home, you'll see it says webinars and continuing the conversation. Well, let's start at the second one first, because after the guest has been here and you've really been excited about what they're wanting to do and you want to help out, how are you going to do that? You come to the continuing the conversation area, and here you're going to have a chance to connect with that guest and figure out all of the ways to connect with them, blog, post, donate, participate. And there's a wealth of them, as you can see, because when you're on the webinar page itself and you scroll, let me zoom to the top for a minute, we'll start all over. Here we go. If you come on down, it breaks out what the two series are about. Here we are at the current one right now. Here's the one for tonight. And then here's the co-host we have for this evening. And then here's who's coming up. But here, very importantly, these are the 4 platforms where these videos are posted after they're completed. So typically by the end of the weekend. So here's an example of the Brighteon page, and you'll notice, look at all these fantastic guests that go back for years, every Wednesday without missing a beat. And sadly, a lot of this stuff is as current as it was recorded maybe 6 months, a year and a half ago. It's still significant right this minute because we still got that problem. So you want to flow through these and then come back and connect with any and all those guests that really hit your fancy because it's that critical. So that's kind of how this thing rolls. And now let's kind of find out where we're going to be tonight. So I'm going to kick this back up here to the 4 o'clock slot. And Charles, if you'll jump in here, would be fantastic.
Gladly, Jeff. And this is an exciting event for me. I've known Mark since the 90s when I was the lobbyist for the mortgage brokers, struggling with the congressional banking committees. Reluctant to help the wholesale end of the market because frankly the mortgage brokers were small mom and pops without much resources to help the re-election efforts of the politicians, and that always makes it difficult to get the attention of the politicians. A lot of staffers cared about the issue, and our problem was with HUD, whose negligence was allowing bankruptcy at the wholesale end of the mortgage market because the way brokers got paid was being alleged as a referral fee and was subject to class action elimination. So that's a couple connections I have with Mark is the banking committee where he ended up working. And he also worked at HUD, but not in an area where I directly was involved, but more in higher level finance. I think he's an expert in the whole GSE efforts, Fannie and Freddie, which buy up all the mortgages and sell them to Wall Street investors. And, as I kind of grew weary of the corruption of DC and became libertarian, I got a great job at the Cato Institute in the early 2000s. And I think Mark ended up working there later than I on housing and finance issues. Mark is so good that he got hired by Vice President Pence to be his economist, and then an economist for the White House at large, and he's worked on all the big issues around the Treasury Department and the housing agencies. We should have a good Q&A. Think of any question. I know folks are worried about going back to work, and I know investors are worried about empty office buildings, and landlords are worried about tenants that don't have to pay them, and workers are worried about having to go to work. They want to telecommute. So the whole property markets are, a subject that we should explore on Freedom Hub. So that's my intro, Jeff.
All right. Excellent. Well, on that note, I'm going to stop my screen share, and Mark, take it away.
Thank you, Jeff and Charles. Thank you for that kind introduction. You brought back some painful memories about yield spread premiums and RESPA and all that fun mortgage broker stuff that I thought I had completely blacked out of my mind. But it's nice to kind of have that memory lane. And what I'm going to do is talk a little bit for a few minutes. And I'm happy, as was mentioned, worked at the White House on a number of issues, including China and trade and taxes, and happy in the Q&A to go into any of that. But what I want to do now, for those of a little bit more of a background, some of you may know that the end of June, the Supreme Court put me out of a job. The focus of the Collins case, while dealing with GSE, Fannie Freddie shareholders, also dealt with the independence of the structure of the agency that I was running at the time, the Federal Housing Finance Agency. And what I want to use today for is that I've started, since leaving the agency, working on a book project to really kind of tell the tale of how we at the agency, me particularly, but also working with my friend Ben Carson, really led a response to the mortgage and housing market from COVID that I think really worked well, in a story that really needs to be told. So I'm thinking of using you today as guinea pigs, if you will, for me to run some themes by you from what I'm working on in the book, and to kind of get your feedback on where things should be explored a little bit more, what things you think would be interesting. One of the reasons that I just think it's so critical to write the book is we're often told, and again, I was on the banking committee in the Senate during the 2008 crisis, and there certainly was a sense of, we had to burn down capitalism to save capitalism, if you channeled Hank Paulson and President Bush and others at the time. And I'm going to go through some examples of this, but I really felt like that the way that the crisis was handled by myself, and to a degree, Secretary Mnuchin and Secretary Carson, was we were able, in many instances, I would argue most instances under my jurisdiction, maintain our free market principles in the face of a crisis, and that we didn't have to abandon capitalism to save it, but that we could do the right thing and have it work well. And I just think that's an incredibly important story to get out there, and tell that a crisis does not require you to abandon your principles. And I would go as far to say that a crisis actually, you will get better through a crisis if you are guided by your principles. As mentioned, I was on the banking committee during the 2008 crisis. I also led the banking committee's response to Katrina in 2005. And a number of lessons from those crises really inform my view about how we should respond to COVID in our housing and financial markets. And so let me walk you through kind of some of the lessons that I took away, which I'm the first to recognize may not necessarily be the conventional wisdom on many of these issues. So for instance, one thing that I take away from the financial crisis that I do think is counter to maybe what you hear conventionally is, my lesson of Lehman Brothers is that, for instance, if you give an institution multiple occasions to believe that it will be rescued, it will reject offers that it doesn't believe are favorable. And of course, as we know, Lehman Brothers had at least 3 different offers to be rescued. It repeatedly rejected those offers as a low ball and was unwilling to take price below what Bear received. And therefore, it failed because, again, it would not take the necessary reactions to save itself, because it was holding out for a rescue. And so you ask yourself, well, what's the relevance of such for COVID? And I will take you back in time a little bit, because we set up a number of forbearance programs. And again, I want to emphasize this was not mortgage forgiveness, it was forbearance. borrowers are required to pay it back. But there's an element of the mortgage industry called the servicing industry. And these are essentially the lenders, the functionaries who take the payments from the borrower and forward it to either Fannie and Freddie, which are forwarded to the investor. And so when forbearance was put in place, many of these servicers had to continue to pass along the funding for up to 4 months, even when the borrowers weren't paying. And obviously that could mean some amount of financial stress for the servicers. Of course, the servicers had signed contracts and agreed to do such. So I think it's just, so the parallel I'm giving here is that you had a very similar situation among mortgage servicers as you had with Lehman. You know, there was a sense that they needed to be rescued. There were broad calls to set up a liquidity facility. They had certainly first came to Fannie and Freddie and said, we'd like you to fund our liquidity. That is, we'd like you not to hold us responsible for the obligations that we've promised you. And there was a big push to have the Federal Reserve set up a facility under the Fed's 13.3 powers. And of course, that would ultimately be the decision of the Treasury Secretary. And so we really took an approach of first looking at the data. So there are about, at the time last year that this was an issue, 346 non-bank servicers that Fannie and Freddie did business with. As regulator, I was getting their income statements, their balance sheets. We knew the financial condition of these servicers. And the one thing that was immediately clear to us from the analytics we were doing at FHFA is that these servicers did not need a bailout in terms of there being a systemic problem. There essentially was almost under no set of circumstances where we are looking at would the entire industry fail. And of course, there was a very different narrative out there. I want to read for you, for an instance, here's something that the Financial Times wrote, said, it looks as though significant parts of the system where tens of billions of dollars will crash in May. And of course, this was written in April of last year. And I would read a little bit more. My favorite part of actually this op-ed by John, Dillard was the part where he says, Calabria being the unlikely villain who's bringing down the mortgage market. And of course, this was only one, and this is again an illustration of so much of what goes on in a crisis, is that you get so much industry pressure, and of course, there's a fair amount of risk aversion on regulators. So I can say, for instance, in my conversations with the Federal Reserve had put a liquidity facility up and was ready to turn the key as soon as Treasury said yes. But at the end of the day, Secretary Mnuchin was not convinced the mortgage servicers needed it. But one difference between my friend Stephen Mnuchin and myself was Secretary Mnuchin was very happy not to say anything. His approach was, we're just not going to rescue the servicers, but we're not going to tell anybody. We're not going to rescue them. And it took me back to the Lehman question, the Lehman lesson. And so I thought it was important to go out publicly, and partly because we had the financials of the servicers. I was aware of the half a dozen or so that were, if you will, riding the line. And so I thought it was important to go out publicly and say, listen, the cavalry's not coming. And at least two of these servicers, and I should qualify this with, I've certainly got nothing against private equity. At least two of these servicers were largely funded by private equity that had taken substantial money out. So we made it clear that if these investors wanted their investments, these servicers, to remain in business, they should perhaps put some money back in, and that we weren't coming to the rescue. And then lo and behold, they came back and put money in. And of course, they didn't get it free at a zero rate like they would have gotten it from the Fed. But there ended up being a non-crisis because we were driven by the data. I made very clear nobody was coming to the rescue, and that we were capable of transferring their business to somebody else. And a fundamental tenet, again, I take of capitalism is failure has to be an option for firms. So we made it very clear, we will let you fail. We have put in facilities in place to transfer your business to somebody else. And so go out and raise capital. And I think this is just such a critically important lesson because obviously, I think it may be fair to say I was in the minority over the last year and a half where almost everybody who seemed to want to get a bailout got one. But anything within my purview, we weren't rescuing, we weren't bailing out. with the exception, let me say, and I don't really look at this as a bailout, it was really looking at liquidity issues. And so the next really question that I thought was core of the financial crisis that I probably been giving a lot of thought to on a regular basis since the financial crisis is the question of whether, are we facing a liquidity shock or a solvency shock? And so we quickly realized in the case of borrowers that what was the focus for COVID was job loss as a result of COVID, and with the expectation that those jobs would eventually come back. Of course, we didn't know when or how quickly, but fundamentally, we were looking at an environment where most borrowers had lots of equity. So we weren't in a 2008 scenario where mortgage borrowers were underwater. We were in a scenario where mortgage borrowers, at least in the Fannie and Freddie book, were facing significant job loss, but had equity in their homes and would likely want to keep their homes. And so we quickly set up a forbearance program. One of the things, one of the reasons I think the book is worth doing is to talk about kind of the decision making and some of the struggles. And one issue where I would be the first to say, and it was perhaps probably the biggest gamble, you will, that I took in terms of, will this turn out well? So by contrast, I mentioned the issue with servicers. We did a lot of stress testing. We did a lot of scenario analysis with servicers, and there really was just not likely scenarios or even unlikely scenarios where servicers would face a systemic crisis across the industry, despite what the Financial Times and even Bloomberg and others posited. What we didn't have a higher degree of certainty on was, what do we do about borrowers? And so one of the real problems in the financial crisis in 2008 was what I call kind of a paper chase. Borrowers, to get any sort of assistance in 2008, had to fill out reams and reams of paperwork. Often the paperwork was lost. Sometimes it didn't get to the lender would reject it. And of course, there's a rationale for this. Obviously what the lenders and the assistants in Washington was trying to do was to minimize the moral hazard of borrowers who didn't need assistance taking advantage of it. Now, we simply didn't have the time, and there was certainly too much uncertainty for us to try to do something similar. And so this is the biggest area where I rolled the dice, if you will, and said, we're just going to ask borrowers, have you been adversely impacted by COVID? That is, have you lost a job because of COVID? And if you have, we're going to take you for your word, and we're going to put you into a forbearance program with, of course, the understanding of you will have to pay it all back. And I also went out, media, television, otherwise, and said, listen, if you don't need assistance, please don't take it, so that we can focus our resources. And I do think that one of the problems in 2008 is what I would call is kind of a reverse triage. So much of the focus post 2008 was just helping people who largely didn't need it. I'm sure many of you, like myself, were able to refinance in the low interest rate environment post 2008, but I certainly didn't need it. And one of the things that I really thought we needed to focus on was, let's put all of our energy on people who were really suffering a hardship, rather than put our energy on hitting very large numbers and pretending we're helping people who aren't necessarily feeling a stress. So one of the focuses that I thought really was the approach we needed to take, which I believe was the opposite of what was taken in 2008. And many of you might remember this, a sort of semi-famous, infamous quote from Tim Geithner when he was Treasury Secretary, that he saw much of the forbearance programs for borrowers as essentially foam on the runway for the banks. And we really kind of reversed this and said, our way of helping Main Street is not going to be through some sort of bailout of Wall Street and hope that it somehow trickles down to Main Street. We were going to set up assistance programs that worked directly for borrowers and worked with those borrowers to keep them in their homes. But again, in a way where we could get them through a liquidity crisis and get them on their feet. And again, I think that quite frankly worked out quite well. And one of the other things that we did that I thought was critically important was we published estimates of how much this was going to cost us. And then we levied a fee on higher income refinancing to pay for it. So one of the other, I think, important lessons here is we were able at FHFA under my leadership to assist probably just under 2.5 million families and do it in a way that represented zero cost to the taxpayer. We kept all the costs within the system of the mortgage market. And I recognize that perhaps that's not as big of a deal when now trillions are being thrown around either way. But it was a point to say, we can focus on providing assistance. We can keep the assistance within the programs, and we can make the beneficiaries of the programs pay to provide for those who are being assisted by the programs. And again, that's a little bit of what we were looking at. And then lastly, let me talk about in terms of the 2008 lessons, if you will, that I took into this. For those who dabble in the financial services world, or at least interest in banking, central banking history, are well familiar with the concept of Bagehot's rule, where you may lend freely, but you lend at a penalty rate. And so, for instance, one of the issues that we found was a large number of banks were claiming, a large number of originators, rather, they weren't all commercial banks, were claiming to be stuck with mortgages that went into forbearance after closing of the loan, but before delivery. And for those not familiar with the mortgage market, when you get your mortgage and you close on the loan, it's usually something like a 45 to 90-day period before the lender, if the lender doesn't keep the loan, actually transfers it to Fannie, Freddie, or other investors. And it's historically been the case that the risk of that mortgage during that process is stuck with the originator. So if it defaults or historically goes into forbearance, the originator is the one that has to keep it. So as you could imagine, and the reasonable estimates, well, first I should start, there is a active secondary, sort of what's called a scratch and dent market in the mortgage market, where mortgages that have defects can be sold. And so at the time, we were getting requests from essentially mortgage originators to buy these loans at par, when the scratch and dent market was applying discounts of 25 to 30%. So very clearly, they were not worth par. You could imagine if we had set up a scenario we were agreed to buy them at par, we would be flooded with a tremendous number of mortgages where people were trying to transfer their losses to us. And so one of the things that we set up was we set up a pricing mechanism where we said, here's the discount, which ended up being close to about 7%, where we felt that it was enough of a discount that anybody who didn't need the liquidity, for instance, a depository that could hold it on balance sheet, would not find it attractive to sell to us. And anybody who would need it would take the hit and buy the liquidity. And again, I think at the end of the day, we got a few thousand loans, which again was an appropriate amount that we were looking at. But again, this is an example of literally Bagehot's penalty rate rule in practice. And of course, part of this was to remind the market participants that Congress chartered Fannie and Freddie to essentially be buyers of last resort, not buyers of first resort, and to, of course, remind originators that the risk prior to delivery sat with them. And the reason I tie this back to the financial crisis is I think it's fair to say that most of the assistance that was provided during the financial crisis, the 13, 14 different programs that the New York Fed set up, and many of these programs, they weren't charging penalty rates. Almost always they were a subsidized rate. And again, this was a lesson of you can create a penalty rate, provides liquidity to the marketplace, and does so in a way where you're also not being adversely selected, where everybody's trying to pass you their junk. So for me, as someone who suffered through a PhD in economics, it was very fascinating and interesting for me to see that we could actually build programs based on sound economics, sound market principles, and they would work and the market would be stabilized. And of course, we'd get complaining that we weren't handing out subsidies to everybody, but the fact that it literally worked quite well. And I'll mention another example before I move on. We started at the beginning of this year restricting some of the Fannie Freddie activity in markets that were non-core missions, such as investment homes, second properties. And of course, as we were told from many, that the markets would just completely shut down if we did this. And in fact, what we have seen is a large uptake by others in the marketplace who are making those loans. So part of the point here is there are numerous examples of where we were told worst case scenarios, that if we didn't assist the industry, didn't pass along subsidies, that the world would basically come to an end. And I would really encourage you to go back. I mean, I certainly intend in the book to relive some of the headlines from last year where there were these threats of everything coming to an end if we didn't rescue everybody. In that most of those things just simply aren't based in the data, aren't based in analysis, are based in hyperbole. And that if you're really kind of following through with a principled approach that's data-driven, analytics-driven, that at the end of the day, you'll be proven right. And again, part of the story of the book really is to walk through those examples. Another principle we really drove to this was to try to make this, a win-win policy. So one of the things that we recognized very early on in the pandemic was that this was, in terms of the job market, going to be a renter-driven crisis. So, for instance, only about 40% of those who lost their jobs as a result of COVID have mortgages. About 50% were renters, and about another 10% own their homes free and clear. And so one of the things that we felt that we needed to set up immediately was some sort of assistance programs that would be geared at renters. And again, this was something done for the first time for us. The single family assistance programs we based off of what had been done in disasters. So, we had a Katrina model, Maria model, whatever your favorite hurricane is. We had a model that we could modify and did modify, but setting up the multifamily program, really one of these things where you're flying the airplane while you're building it, if you will. But one of the principles we really took to this, and which is in contrast to the CDC moratorium, we made it voluntary. So, for instance, the landlord could agree to be in it, and what we would do in exchange for not evicting for non-payment of rent was we would press pause on the mortgage. And of course, the landlord would have to pay the mortgage back at some point. And you had about 200,000 renter households that were covered eventually under that. And it really was structured as a win-win. Again, the money would have to be paid back. If the renter was facing a liquidity crisis, and therefore the landlord was facing a liquidity crisis, we would give forbearance and it would all be paid back. And it was all voluntary. So no landlord was ever forced. We didn't put a moratorium on people who didn't choose to this. And I think we were seeing the results, of course, of the continued CDC moratorium on the rental market. I've certainly repeatedly heard stories of landlords now charging like 6 months rent on the front end going in, and much bigger, deposits. So you've really seen an adverse impact. Of course, none of this is surprising. If you make it more costly and more uncertain to be a landlord, landlords are going to price that. And we've certainly seen that in the market. So really what we had designed at FHFA was trying to balance this in a way where you would not adversely impact the availability of rental housing. Because ultimately, if you make it expensive to be a landlord, you're going to have less landlords. And we didn't want to have a system that really deterred that. So I think we came up with a real win-win. We also looked at this, as I mentioned before, making sure that what we were doing was extremely data-driven. I mentioned our data on servicing. We did a lot of projections. One of the things that we very early concluded, and maybe I'll take a little credit for perhaps being the best forecaster out there in a way in terms of the mortgage market. I believe it was about the third week of March of last year. I was on with Diana Olick on CNBC, and she said, "Mark, how bad's it going to get in the Fannie Freddie book?" And my response was, our projections are by the middle of May, we'll have just around 2 million single family loans in forbearance. And then lo and behold, we peaked in the middle of May at 2.1. And that represented about 6% of the Fannie and Freddie book. And this goes back to the point about servicer crisis. You were seeing projections out there of 30, 40, 50%, which really had no basis in reality. We had done a lot of analytics, looked at the 2001 recession. We looked at previous recessions in the 90s and really came up with conclusions of this is really what we're looking at, worst case scenario. And our numbers were essentially dead on, and very proud of our analytical capability. And we stuck with those numbers. Of course, those out there who are advocating for assistance and saying things are going to be worse, we were an open door and wanted to hear how they were coming at those numbers. And unfortunately, it looked like most of those numbers were, quite frankly, just made up advocacy numbers rather than actual real projections. But I really did think that because we had set up, and I didn't mention this, but one of the things we didn't have when I walked into the agency in April of 2019 was we didn't really have a research function. We had been without a chief economist, I think, for 7 years before I got there. We very fortuitous timing in that in January 2020, we set up a division of research and statistics, hired a couple of additional economists. And then when the crisis hit, we were able to do mortgage market forecasting. I'll tell you, one of the things that probably shocked me when I first walked in the door at FHFA was we didn't even have a house price forecast function or a macro function. The agency completely relied on whatever numbers Fannie and Freddie gave them. And of course, we needed to have an independent view. And that independent view allowed us to think I'd take a thoughtful approach to COVID. And again, do it in a way where we weren't putting taxpayers adversely at risk, and we kept the mortgage market going throughout that time. Lastly, let me just turn very quickly and say, I'm also, extremely proud of the fact that not only did we at FHFA be able to provide some support for the mortgage market at no cost to the taxpayer, we were able to continue to do our day jobs. And I'll just first recognize when I walked in the door, Fannie and Freddie were leveraged 1,000 to 1. I think it's fair to say that no financial institution that highly leveraged survives a financial crisis. They came in because we started building capital almost immediately. They came into COVID leveraged more closely to 150 to 1, which is clearly still too highly leveraged for a financial institution. But because we were able to build up capital by the time COVID hit, which ultimately the costs for COVID on Fannie and Freddie are probably going to be around 10 to 15 billion. So we were able to build up capital at the company. We didn't take a draw. We didn't ask for a taxpayer bailout. So again, I take great pride in the fact that we were able to get Fannie and Freddie through this crisis without asking any money of Treasury or the taxpayer. And again, set that up in the right way. We were also able that time to put a capital rule in place that I think will protect the system better from risk from Fannie and Freddie. And lastly, we were able to put a resolution plan in place, a so-called living will. And so really important in place that we have a framework that when I walked out the door at FHFA, that we're Fannie and Freddie to fail. We know how to resolve them in a manner that's not going to be a cost to the taxpayer. And that's not going to disrupt the financial markets, and that will allow us to transfer those losses to creditors rather than the taxpayer. And so, of course, if future administrations choose to bail out Fannie and Freddie, it will absolutely be a bailout of choice because we've put the tools in place to avoid that. So with that, that's kind of really the broad scheme of the outline of the book I'm working on. Again, just started, and would love to kind of get feedback from folks on what are some issues that you think would be more interesting for me to dig into. What are some questions you think you would find interesting? Or maybe I'd put it this way, what do you think I really need to talk about to get you to want to read the book?
There you go. That's the most important way to frame it.
I mean, after of course you finished John's wonderful book on George Washington, hopefully I'll have my book ready to go by then.
There you go. We'll cue that right up in our little book feed. Here's a question for you, and then we have some hands up for sure. But the thing is, obviously, we can debate whether there's agencies should exist at all and go down the list. But obviously, what it also showed is that, okay, let's say we have to deal with this and keep this horrible thing. Can we make it work, or at least work to some degree? And obviously, you proved that can be done. Is there a way to lock in what you do, or is just the whim of whoever's next says, forget all that, we're just going a whole different way, and anything you did is almost for naught in certain ways?
It's a great question, particularly now post the Collins case, where the FHFA is no longer independent and is going to be subject to some extent to political whims. Let me say, because what a question I kind of get from friends occasionally, and everybody kind of heard in the intro of the years I spent at Cato. Was a question I'd kind of get was, how is it, being essentially, from Cato and then trying to run an agency with entities that you may not even think should essentially exist. And of course, my response was always, it's actually quite easy because at heart, I'm an Article 1 guy. And my role at a think tank was to offer opinions on broader policy, whereas my role running an agency was essentially carry out the policies that Congress implemented. And I think a big problem at FHFA over the years was really a move away from that. I would go as far to say for most of the existence of FHFA and the conservatorships of Fannie and Freddie, which all began in 2008, you've really just seen a continued deviation, of the law. And again, one of the things that I think I really tried to help do was really just focus on, the responsibilities to file a law. So for some reason, before I got there, there was a narrative that, an exit out of conservatorship for Fannie and Freddie was somehow some congressional prerogative when, of course, Congress had already decided. Congress had already set up a framework. And all we were doing was simply implementing the framework. So I do think I helped reset the conversation that the expectation for a regulator should be to follow the law, and that the broader public policy questions ultimately, remain with Congress. I am very much worried. I mean, it's also worth observing that the Collins case, while it directly applied to me, and of course, I think as many people know, right after the Collins case, the Biden administration went after the Social Security commissioner based on the Collins case. And I think a read of the Collins case would also suggest that the control of the currency is no longer independent. And of course, the CFPB director is not independent. And the CFPB director and the control of the currency are two members of the FDIC board. So that means you almost have half, just 2/5 of or currently half of the FDIC board is not independent. So we really have seen a sea change in a year in terms of our financial regulatory structure losing its independence from politics. Now, of course, if you're a unitary executive person, and I understand and have some sympathy for those arguments, you probably see that as a real win. I don't, I have real concerns because I think the temptation in financial regulation is really just to essentially gin up credit in the short run for political purposes. I mean, for those of you who are sort of familiar with the political business cycle models and literature, it's, that apply mostly to the Fed, you have the same sort of mechanisms at Fannie and Freddie and at other financial regulators. So I am very much worried that the aftermath of Collins is going to be a greater politicalization of the mortgage market that ultimately will take us back to what caused the 2008 crisis again. But in a way, we did put a regulatory structure in place in HERA, the Housing Economic Recovery Act in 2008, that if the regulator followed the law, implemented the law as it's written, that I think you could solve 80% of the problems with Fannie and Freddie, which is what I was trying to do. So I do think the legal tools are there. Unfortunately, you really don't have the infrastructure that's there. The whole wide variety of stakeholders around mortgage finance certainly don't want FHFA to do its job as a financial regulator. So you don't have the sort of institutional, the public, well, the interest group support for FHFA doing its job. But at the end of the day, the tools are there. The right person, the right support can certainly fix Fannie and Freddie. Again, 85-90% of what's there can be fixed within the existing statutory framework.
Again, sadly, there's that right person situation, which of course is always a rare bird.
It
Murat,
is.
I see your hand up.
Yeah. Mark, great presentation. Thank you for this. I had a question, since you do forecasting, are we in a housing bubble? The reason I'm asking you is, over the last 2 years, just after COVID started and then post-COVID, some of the places like Silicon Valley and all, the rates have gone up by 20-25%, which you have never seen. It's
crazy.
Crazy, it makes it impossible for, a person living in California or Silicon Valley to afford to buy a house. A single family home is 2 million and 2.5 million and 3 million. Can't imagine, So what do you see? We are in a bubble.
Well, maybe I'll say that, talk is cheap. So who puts their money where their mouth is? So before I get into the details, I'll just note that I'm in the process of putting a rental property I own on the market because I think it's the time to sell. So, I'm willing to put my own money on where that is. I've always kind of been uncomfortable with the term bubble because, within academia, of course, it implies that you have prices that are deviated from fundamentals. And I really kind of prefer to use the word bust because on one hand, I do think that the prices we're seeing in the marketplace, which again, the price increases you've seen over the last year have been the largest perhaps ever on an annual basis in American history that I'm aware of, or at least since we've been keeping numbers. But what I think concerns me is that they may reflect the existing fundamentals. So they may reflect the low mortgage rates we have. You certainly still have a lot of constraints on the supply side. Not only is it a lot of the existing inventory has been kept off the market because, quite frankly, a lot of people have not been comfortable, showing their homes in this environment. And of course, you also saw all sorts of bottlenecks. Not only have there been, prices in lumber and other things that went up and came back down, and supply chain bottlenecks, but there's also a lot of bottlenecks in local government. It's been very difficult to get permitting, get land entitled. So you have a lot of supply constraints. You have a lot of drivers of demand, not only the easier interest rates, but obviously the savings rates just skyrocketed over the past year. And so you have a lot of households. I mean, it's shocking when you look at some of these markets where the percentage buyers are all cash. And so you've got a lot of segment of the population that, they didn't spend their money on vacation. They didn't spend money on commuting. They may have got some sort of relief checks and they've been saving. So to me, the prices are reflecting just a massive increase in demand with a significant contraction in supply. And the reason I don't like to use bubbles because I think those fundamentals are going to change. I think over time we're going to start, and we've already seen this, the National Association of Realtors, others do surveys. You've already started to see over the last 6-8 weeks, more and more existing homes come onto the market. So that supply is starting to kind of get back into the market. We have fortunately recovered all of the residential construction jobs we lost during COVID. And you still see a lot of vacancies there, but we're back to building. I mean, we're building more than we were pre-COVID. So I do think you're going to start to see a bigger supply response. Certainly forecasting interest rates is always a bit of a gamble, but I think it's fair to say that over the next year, you're probably going to see mortgage rates start to trickle back up. So where I conclude from this is number of factors suggest to me, and of course, you still have significant number of households that are in forbearance in the mortgage market, which obviously we've kept that supply off the market. And certainly most of those borrowers will actually cure and be able to get back on their feet, but there will be a significant number of borrowers who won't, and that eventual inventory will get back into the marketplace. So I do see supply continuing to shift. So, I forget, one of my forecaster friends used to say, give a number, give a date, but never give both. So maybe to follow that wise example, I do think over the next 12 to 18 months, we're going to continue to see a moderating in supply and a moderating in demand that will start to moderate prices. There are pockets. One of the things you often hear is the quality of mortgages. And certainly, I spent my entire 2 years at FHFA improving the underwriting quality. And so we did minimize a lot of the tail risk that's in the mortgage market. I'll say as an aside, we did so at a time where you saw record increases in African-American homeownership, minority homeownership. So you don't have to loosen underwriting and take risks to be able to increase homeownership. I spent 2 years showing that it can be done in a safe and sound and responsible manner. But all that said, I do think you're going to start to see that moderation. And you do have a segment of borrowers, for instance, in the FHA book, right before COVID. And, to me, 2019 was, if not the strongest, certainly one of the strongest job markets in my lifetime. And the fact that you had 1 in 10 FHA loans were delinquent going into COVID in that economy, is worrying. So there are patches of the mortgage market where you're going to have some trouble. I don't necessarily think we're in a 2008 scenario, but, as I mentioned, Fannie and Freddie's leverage is about 150 to 1. Were we to see a 2008 scenario, and even if Fannie and Freddie could, tap their lines of credit at Treasury, Fannie would almost certainly burn through its remaining line of credit at Treasury, which of course is in itself a bailout, with potential systemic risk to the economy there. So I would simply say there's a lot of parts of the mortgage market that do give me concern. But I think at the end of the day, we are headed to a scenario where that starts to deflate. And again, as I said at the beginning of that question, I'm putting my money where my mouth is. I'm putting one of my properties on the market.
Thanks, Mark. And one more, just a side question. There's a whole disability community of 6 million people in US. And affordable housing for them is real concern. And parents who have children on the neurodiversity and on the spectrum, it's really bad situation for them, and they're not getting support neither from the local community nor from the federal government. Do you feel something will change for them?
It's a mixed bag. So I would say, to me, I was talking about supply constraints in the mortgage market probably 20 years ago. And so I guess one reason why I'm, a glass half full guy and optimistic about it is there's at least a broader conversation and recognition that particularly in coastal places, like California, that the supply restrictions and particularly the environmental reviews in California are just insane. You've really kind of bottlenecked construction. And of course, that means that you're continuing to see population flows out of California. And of course, I think the wake up call was perhaps losing congressional seats for California. That, again, and they've got plenty of land in California. This is not an issue of run out of land for people to live. It's completely a regulatory environment. And so one reason I'm optimistic is I've seen the conversation change over the last 20 years, partly because post-financial crisis, the regulatory environment for housing actually got worse on the supply side. It's certainly one of the things that we focused on in the White House. We didn't have a lot of leverage over housing, but we had leverage over infrastructure. We tried as much as we could to streamline the permitting processes at EPA and Interior and other agencies. And I think that made a big difference in terms of getting things built. And there needs to be a streamlining and deregulation at the local level, particularly, again, in places like California. So the reason I'm partly positive is because I think that's a conversation that's really kind of reached the surface and is a bipartisan conversation. But at the end of the day, I guess certainly worth keeping in mind, there are very strong incentives for local homeowners to oppose opening up the regulatory structure and allowing more construction to be built. So at the end of the day, what's going to win out here, I think, is the question. But I do think a lot of businesses are getting involved in recognizing that if you're not in a location where low income, median income workers can actually live, then you're not going to be able to have those workers. So I think we're in an environment where there's a bit of a wake up call, but I'm cautiously optimistic, I would say, in that regard, that we can make progress on that front.
Thanks, Mark. And if you need any help on the book, if you want to take any interviews or something, I have some groups. So,
Absolutely. Really, I appreciate the offer. Thank you.
Thanks for the plug for continuing the conversation there, Bharat. That was great. Charles, I see your hand.
Yes, thanks, Jeff and Mark. Fantastic update. You really did a lot there at HUD during the COVID housing crisis, and it was a good memory lane going back to the big Great Recession of 2008. So on your book, I got a few questions. You along with Alan Greenspan, Milton Friedman, Carl Hess, and a few others are well-known libertarians trying to improve the system. For me, given your knowledge, as a libertarian, I would hope that you would consider a chapter sort of dividing your reform ideas, how to marginally improve things like what you've done at FHFA. But, the what if image, what would a true liberty market do to the financial markets? I'm thinking Ron Paul and the Fed, even Romney wanted to abolish HUD. There are so many agencies in finance, consolidation. What about what we're doing in healthcare, trying to replace the FDA with competitive certification? How would that, competitive certification model impact a real market in finance? Number one, talk about that as a possibility for your book, which would broaden its interests among, more hardcore reformers. You may have different audiences you're thinking about, people that from your space in the trenches of housing, financial regulation, but then you also have the Cato crowd. That's one question I have.
Should I answer that one before?
Yeah, go ahead.
Sure. I have a habit of when people
Don't forget it.
Yeah, exactly. I will be the first to admit, people ask me 3 or 4 questions, I forget what the first one was before. So, well, first of all, I'll say the benefit is, I'm not limited to writing one book over the course of my life, but so this book is meant to probably be more of a general, audience. And I certainly wrote a number of things at Cato that I think can be extended on and elaborated on what a free market financial system would look like. And let me say, as a former financial regulator, as a former member of the Financial Stability Oversight Council, everything I saw as a financial regulator has only reconfirmed, my initial beliefs about the importance of market discipline and about a free market in financial services. This is not something where I spent 2.5 years being a regulator. So, oh wow, and we actually need more regulation on all the guys. No, And again, I think the approach that I took during COVID really proved a lot of, our approaches. And again, that you don't need to bail everybody out, and that you could have market discipline, and that the market would take much of this risk. And some of that will be in the book in terms of the mortgage market. But I do think a broader conversation about the financial system writ large. And let me also encourage you, if I can, talk a little bit about, go back to my time at the White House. I want to contrast for just a second. I was really proud to be part of the team that did put in place tax reform. And to me, the fact that we were able to get a lot of reforms in place, particularly on the corporate side, I think we're terrific. While I was not our primary healthcare person, I was in some of the healthcare meetings. And the reason I raise this is to say that, while of course, the Trump administration, and particularly people like Kevin Hassett, Shahira Knight, and others deserve a lot of credit on tax reform, a lot of the reform ultimately goes to Kevin Brady and Dave Camp, because they did a lot of legwork before we got there. It didn't look like, because we all remember the conversations perhaps about border adjustment taxes and things like that, but where we got at the end of the day was really built upon an effort that went on for years, which is why we were able to get tax reform done by the end of 2017. By contrast, there really was not a free market roadmap for healthcare reform when we walked in the door. And I think it's critical that free market advocates work on a real replacement to Obamacare. Because again, at the end of the day, what happened in 2017 was, we couldn't even get Republicans to vote for Obamacare Light because there was no real plan. It was thrown together. It was not vetted over years. It was not, consensus wasn't built. So, I'm not a healthcare guy, although I will say, the meetings I was in, the whole issues about moral hazard and adverse selections that I know from financial services ring very true in the healthcare system as well. And I think a lot of the same government-imposed distortions you see in finance, you do see in healthcare. But I really do want to make a pitch for, I just think it's incredibly important that there is a vetted free market healthcare reform plan that has been put together, before there's another Republican administration. Because if you wait to put it together after Republican administration's in place, I just think the odds are going to be against it happening. Now, so Charles, you had at least 1, 2, 3 more questions?
Well, real quick, wait,
we don't have much time.
Real fast, Charles. So here's the challenge just on that one topic, because it is so critical. Our vetted plan is we want to replace Obamacare with the country's farmers flea market. So how's that going to pass muster? Because frankly, Charles and I've been living in that space for so long. There is no replacement plan. The replacement plan is to get the hell out of the way and let the market figure out what works. But somehow they always want to have some structured thing.
Well, and I think kind of, some of this is how pragmatic do you want to be, and can you have a separated high risk pool and let the rest of the market work? I mean, again, these are conversations, or at least
it's not even that. What kind of doctor am I going to? A naturopath, an allopathic? I mean, there's so many individualized variables. There's no way you could build some master plan, even if we're just trying to focus on paying for the stuff.
And some of it is also thinking about what's a wedge you could put in there. Like if you don't think the plan could get there overnight, can you create a wedge? So I think your views are probably similar to mine in that I think the vast majority of healthcare should basically be a cash market.
Bottom line, yeah, that would solve all the rest of what I just broached.
And so can you create, like you think about HSAs and things like that. Again, part of the point is, can you think of innovations that might not get us to a cash market in 2 years, but might get us to a cash market in 20 years. And so again, I would just really, the bottom line is, we need a better plan than Obamacare Light. It needs to be, and people need to start working on it now. And some of it does need to be along the lines of what can we do that moves us in the right direction, even if it doesn't completely get us there.
Charles, jump back in. Sorry, buddy.
No problem, Jeff. So yeah, we're working on the cash market reform. That's what Jeff and I do for a living, commercially and politically. So thank you for that. You're right on the money there, Mark. Cash is king. It does have a panacea effect. Another HUD issue, smart cities. I'm the lobbyist for the oldest health freedom organization, National Health Federation. And some friends of mine are concerned about smart cities being set up by NGOs in various counties. using wireless methods to institute behavioral scoring. So smart cities, while sounding nice, have a sort of a data monetization angle from big business, which has some of my health freedom colleagues very concerned. I guess to whatever extent you've looked at smart cities at HUD, it always sounds kind of pretty. They don't get into the details.
Who doesn't want to be smart, right?
Any other comments on smart cities, the future there?
I haven't dug into it deeply, but I share the broader concerns. And as you know, the Biden administration, in their campaign, they had they wanted to set up a government rating, a credit bureau. So, the parallel here is I do worry that we're going to start to see things that look more and more like the Chinese social credit scoring. And to me, that's just a nightmare world. So I'm a huge privacy advocate. I do think we need to be very concerned about, government-led data collections and certainly need to be concerned about what the private sector does with our data as well. Now, I'm a big believer, in ultimately, channeling, the Coase theorem or however you want to think about it. The data is, somebody's got to have ownership of data. And I'm much more sympathetic to saying the ownership would lie with you. And then if you want to give your data to people and contract it away, that's fine. But I am worried about the direction we're going in terms of privacy and data control. And that's a very legitimate concern, whether it's smart cities or credit bureaus or healthcare or anything else under the sun.
We have the luxury of having John Barrett.
One last question, Jeff.
Go ahead real fast. I'll let John chime in.
So in your chapters of your book on free markets and giving sort of a big Cato type picture, there's the opposite worry of concentration among giant international conglomerates. We see the articles regarding Vanguard and BlackRock and State Street collectively owning everything with the crossed memberships and boards. How does that trickle down to the financial markets? Do you ever think about that?
You constantly, because both BlackRock and PIMCO, for instance, are very large holders of Fannie and Freddie debt. So I would hear from them pretty regularly, to be quite frank about it. And they certainly have they are certainly very aggressive about representing their views and protecting their investments and their belief that the government should essentially underwrite part of their risk. So it is interesting. And that we've moved to a world over time where, Fannie and Freddie debt, perhaps 20 years ago, was much more dispersely held throughout the financial system, whether held by depositories or insurance companies, to a world where more and more of it is being held by large concentrated institutions whose interests may or may not necessarily coincide with that of the general public and the taxpayer.
All right. I was going to see John Berlau is on here today. We have the luxury of, and I want to see maybe you have a question or a comment. Yes.
Right. Well, thanks everyone, and thanks for coming, Mark. And I weighed in with comments on certain things like you put, I think, it's underappreciated now, and we may have to wait for another Republican administration. But you put it on a path, Fannie and Freddie on a path to both privatization and a more level playing field. You ended what was called the Third Amendment, where the government asserted its right to use Fannie and Freddie as a piggy bank to take, proceeds from Fannie and Freddie long after they had paid back the initial amount the government had bailed them out. And this is kind of but I wanted you to comment sort of on a broader debate among libertarians about, what Fannie and Freddie, the property rights of Fannie and Freddie shareholders. Richard Epstein, who literally wrote the book about takings and property rights, has said, he's been a consultant to some of the GSE shareholders, that a paid consultant, but he can choose who pays him. So that's but that this is a taking, and that they deserve compensation for what the government has taken beyond the bailout, where others have said, you do business with the government, you get what you deserve. I was sort of more taken, and I was sort of persuaded by him and others the Epstein view that, every business, is in some way touched in some way by the government, a defense contractor or whatever. And so if you say people have no property rights and the government can just, like Paulson did with a hostile takeover and, take, like say 90% of a company or I forget what the percentage was, and then say the others, well, since we're controlling, we'll take all the dividends. That's what I wanted. Like in the case of I'm long when in case of the XM, I don't want Boeing to receive the subsidies, but I don't think the government should go in and take it over. So, can you give us some of your thoughts on shareholder rights and contracts, property rights?
Great question, John. And again, thank you for the kind words. So, I mean, I do think that there is a legitimate, shareholder claim on a takings in the litigation, and I believe that's probably. I mean, certainly the aftermath of Collins is they did leave open a takings claim. I think there's some debate about, what the value of that is. So, for instance, I've advocated that. If Congress should either convert them to financial services holding companies or allow additional chartering. So one of the things the shareholders, and I think shareholders of any companies don't really have a legitimate property right in, is a property right to a duopoly monopoly. But that's separate from the property rights that they have is shareholders in a company writ large. And certainly, I actually think one of the more troubling aspects of the Collins decision was Alito kind of took the stance. And let me say, I had the benefit of being the one who drafted much of HERA. And I'll say as an aside, I guess I'm one of the very few people who drafted a removal language in a statute and then later was, removed by the court finding that language not to be constitutional. But that said, we based HERA on the Federal Deposit Insurance Act. And the way Alito read it, he really read some incidental powers to basically swallow the rest of the statute. And while I understand my unitary government folks kind of see the primary structure part of Collins as a win, the really reading of the resolution powers in it was just a massive expansion of agency discretion that I was quite frankly shocked to see come from Alito. But that said, it really does raise some troubling questions, not just about Fannie and Freddie, but about Dodd-Frank and other resolution problems, as well as the FDIC, because again, the same language was lifted basically from the Federal Deposit Insurance Act. So I do think Collins has the potential to really kind of, mix up the pot in a way that relieves a lot of unpredictability about the ability of government just to go in. And so it is, I mean, again, the Collins decision left a possibility of making a takings claim. And, we'll see where the courts rule on that. And I do think the shareholders are likely to have some interest, but the question is really what's that going to be valued at? And again, that's a hard question and a hard answer to come at. But I am deeply troubled about the impact on the government's ability to simply take over companies now that Collins really does set a precedent for in a way that's troubling.
All right. Well, unfortunately, we're going to have to leave it right there, Mark, because we've really been zipping by here pretty quick. So thanks so much for spending all this great time with us today.
Thanks, everybody. Really appreciate the time and look forward to seeing folks in person sometime soon.